I am I audible now? I think I wasn't audible earlier. Some issue. Okay, good evening and welcome everyone. Wishing everyone a very happy Diwali. On behalf of my team and colleagues, Varun, Vikramjit, Rahul, Chetan, Rohit, I welcome you all to this event this evening, where we all get together to seek knowledge and guidance and wisdom from probably perhaps the greatest and the best minds on markets around our side of the globe. Someone who's been so precise in her predictions and views on the market. Not many have achieved that. I've been a part of her team, directly reported to her, so I know the kind of hard work that goes into and how she's built this entire setup from scratch as a first generation entrepreneur. I would, ma'am, thank you so much for sparing time and gracing us this evening for sharing insights on the markets. There are, hazar questions in everyone's mind. War hai, Ukraine, Russia, Israel, Palestine. Of course, then there is the US markets and the US interest rates, which are just not, behaving in the right way. Inflation, everything, everything looks wrong, but the markets are just not stopping in India. सबके दिल में यही. I'm sure we'll get a lot of questions on this, but that's what we are here to learn from you. कि in such times, how to tide the market, what is the way forward, क्या दिख रहा है, कैसे रहना चाहिए. सबका confidence डगमगाया हुआ है. 100% dealing with investors we can make out डरे हुए हैं. पैसा लगाने वाला भी डरा हुआ है, जो लगाया हुआ है जिसने वो भी डरा हुआ है कि निकाल लेना चाहिए. So would love to hear from you and Achin in the next maybe 1 hour or so on what First Global, how First Global makes such a huge difference in its approach in predicting and analyzing the markets, not only domestic but globally. And the way forward, of course, where are we headed as investors, as wealth advisors? What should be our approach? Over to you, ma'am, and Achin. Thank you so much. I would request you to please take over and run us through.
Thanks, Harveer, for a nice, kind introduction. And I always feel proud of people who have worked with us, and I call them our alumni, which are now all over the industry. So we've been around for a lot of people who are now in senior positions on both sell side, buy side, and I always tell them that keep the flag flying high. So coming to what you're saying, obviously everybody wants to know the permanent question, kya lagta hai market, as a KLH as I call it. But we'll obviously come to that. But prior to that, I would also like to sort of set the background as to how we do things and why we do things in a certain way, and where does that lead us. And I mean, in terms of base, I would say that we are very data driven and we are very systems driven. We are not so story driven, so we are not selling whatever, I mean, India growth story, or for that matter, the negative story that you were talking about geopolitical risks and this and that. So you have to look at where the data leads you, where it has, where similar circumstances led you in the past. And since you, I mean, we'll come to it in more detail later, but since you mentioned the fact that people are scared ki abhi nikal jana chahiye, the thing I want to leave with all of you here is this, that all of us understand the risks of being invested in the market, that when you're invested in the market, your portfolio can go down. But there's also a risk to not being invested at any point in time, which is that you miss out on the up move. So whatever you want to allocate to equities, I never say that allocate 100% of your portfolio to equities, but whatever you want to allocate to equities, at times, of course, the risk of a crash is very high, as was the case in COVID time when we went very risk averse. But in many other times when the risk of a crash is not so high, it makes sense to remain invested, because otherwise you might miss out on an up move. And how dramatic that difference can be, I'll just tell you. Now, we did this exercise last year. Actually, we repeated it. Excuse me, I'm just recovering from a viral. So we repeated this year also. So the numbers have shifted a bit, but the percentages remain the same. So if you had invested, let's say, 100 rupees in the Sensex, so when it started a little over 40 years ago, it would become 44,000. This is last year's figure. This year was 55 or so. Anyway, so 40, even if you work with 44, if you missed out in 40 years just the 10 best days, that 44,000 would come down by two-thirds to about 15,000. If you missed out on 30 best days, which is not even one day a year on the average, 90% of your returns would be gone. So, I mean, do you want to risk that? Even at COVID time, and this is, we are there on public record, we had said on March 2, 2020, that something very strange happening. It's not the time to be invested. But in 3 weeks, March 23rd, we again tweeted saying that time to be back in the markets. But if at that time you kept sitting on the fence that I will wait, let things look more certain, and you had just waited a little over a month, in that from March 23rd to April end, both India and US went up nearly 30%. And then thereafter, however carefully you choose your portfolio, you could never make that up. So, I mean, bottom line, where we sit today, I would still think that the sensible thing is to remain invested. The part where you need to be very careful is the small caps. But we'll talk about that in more detail in a while. For now, I will hand you over to Achin, who will talk you through, because as I said, it's very important to understand the way we do things rather than only look at the conclusions. So, he will tell you about the process that we follow and why we follow that process and where does that lead us. Achin, over to you.
Thank you so much, Devina. I hope my screen is visible now. Harbir, can you?
Yes. It's pretty much visible.
So, good evening, everyone. Today we are looking at the central question for investors, which is there a one-stop solution for all your investment needs? Our options have expanded with technology, offering a range from equities and REITs to commodities and precious metals. Choices are great, but making the right decision is the key. So whether you are interested in specific markets like India or global investment opportunities, it's important to find a balance that fits your portfolio. And over the course of the next few minutes, we will talk about our game-changing approach to investing that Devina briefly mentioned about, that combines the best of humans with the best of machines into a seamless investing model. And as we move forward, let's just take a moment to acknowledge the solid foundation that we are standing on. With 3 decades of expertise in Indian markets and a quarter of a century of global presence, our experience speaks volumes. And our journey doesn't stop there. I mean, while these years have shaped our understanding and strategy, there's much more to our story. Let's delve deeper and discover the breadth and depth of our knowledge and how it translates into success for our clients. So let's dive in. It's often said that the proof of the pudding is in the eating. So let's first look at the performance of our various products. This, what you're looking at right now, is a performance of our equity focused portfolio under a PMS structure in India. This shows our performance since inception till the last completed month. So this is the entirety of our history under the PMS structure. As you can see, a crore invested in the India Super 50, which is our equity portfolio, would have become 2.4 crores as of the end of October, whereas the same crore in the benchmark would have become 1.8 crore. And not only have we outperformed the benchmark Nifty, but we've outperformed every single multi-cap, large cap peer in the entire PMS industry. So this green line at the top that you see, that's us. then there's a huge gap, and then you have the rest of the players all clustered together at the bottom. And same data in a bit more detail. So as you can see, in terms of returns, we've delivered 141% return since our inception, which not only is it far higher than all the names that you see here, but in fact, most of these names that you see have not even matched Nifty returns over this entire period, let alone come close to where we are. So, all of these Motilal, Axis, IFL, Ambit, Marcellus, ASK, they've not even matched Nifty returns. But returns is half the story. When you're looking at returns, it's equally important to understand the risks that are being taken to deliver those returns. That's where the rest of these two columns come in. So this column in red, which is the CAGR by volatility, tells you how much return was delivered by the portfolio for every unit of volatility. And once again, as you can see, we're far, far ahead of everyone else. And this risk adjusted measure truly shows the gap between us and the rest of the peers. There's hardly anyone, we are at 1.67, there's nobody at 1.5, and there's just a handful of people above 1. All of the rest of them are below 1, as you can see. And the next metric, which is equally important, is a gain to pain ratio. Once again, very simple metric, very powerful. You take the net return that the portfolio has delivered and divide it by the gross losses over the entire period. So how much net return have you delivered for every unit of drawdown that the investor had to endure? Once again, we've hit it out of the park. We're far ahead of everyone else. And then a similar comparison with the mutual fund space, where we are looking at the top large cap, multi cap, and flexi cap mutual funds. Once again, the story is the same. We are at the top, everyone else trails behind, both in terms of returns and risk adjusted returns. And then finally, this is the performance of our global multi asset product versus the corresponding benchmarks. So this has been around for almost 9 years now, and we've delivered a dollar CAGR of 8.2% per annum, whereas the benchmarks are between 4.5 to 6% in the same period. So once again, $1 million invested in this product 9 years ago would have become 2.1 million today, whereas the same amount in the benchmarks would be around 1.5 million, around that mark. So given that we've looked at the performance, the all important question that arises is this: how have we managed to deliver such stellar performance consistently over time? Now, we pride ourselves on a unique approach to investing, which, like I mentioned, is one that has been honed over years of experience across global markets. First and foremost, the results are not the outcome of any individual person's brainwave or whims and fancies. In fact, the old school fund management model, which is one where a human, one or two individuals drive the entire investment process, that entire approach no longer works. No, because if you look around, technology has brought in disruption in so many fields. Think of a sport like hockey, where countries like India and Pakistan used to be a dominant force from the 30s to about the 70s, and then the game changed. They moved from grass to astroturf, which meant that you needed a completely new set of skills to dominate the game, and countries like India were not able to keep pace. Hence, they lost their domination. Similarly, in tennis, they moved from wooden rackets to titanium rackets, led to a completely new breed of players dominating the game. And we are seeing a transformation, a disruption happening in the space of automobiles right now in front of our very own eyes. The move from internal combustion engine to electric vehicles is happening as we speak. Similarly, there's a huge tsunami that is going to blow away the traditional fund management model altogether. How is that happening? So there was a point in time when access to privileged information was a key edge that many human fund managers had. So they had additional information which the rest of the market had no access to, and hence they could deliver stellar performance. But that has been regulated away to a very large extent, which is why, by the way, you don't see the traditional fund managers outperforming the markets anymore. In fact, now there is the opposite problem, which is that there is a deluge of information available in the public domain, and there is so much data that humans cannot absorb and process all of it. So you see, the edge has moved away from having access to information to having the ability to process that information and generate actionable intelligence. And that is where machines have an edge. So let's spend a few minutes trying to understand why machines work well in the first place. Now, the machine can analyze a large number of securities. So our systems look at more than 20,000 securities from across the world on an ongoing basis. No human fund manager can come even close to that. And it's not just the breadth of coverage. Our machines allow us to analyze every single security across hundreds of factors, which is once again humanly just not possible. We use very nuanced, very granular factors. For example, we calculate what is the probability that the company is manipulating reported numbers. We are looking for things like, is there any evidence of earnings smoothing happening? Are the accruals unsustainable? Are the accounting policies changing too often? So all of this is being tracked by our systems very, very efficiently. Next, extremely important, human beings are basically the creatures of their biases. Devina has written and spoken widely about human biases. The long and short of the whole story is that human beings were not meant to be good investors. We humans are the outcome of millions of years of evolution. Evolution had other objectives in mind, survival of the fittest, but being good investors was nowhere, in the bigger scheme of things while humans were evolving. uh, there's a very, very long list of biases that we suffer from. Okay, I will I understand that you already know what a lot of these biases are. uh, the point is that each one of these biases come in our way of making sound investment decisions, and the key question is, how do we eliminate these biases? Okay, and the unfortunate answer to that question is, it is just not possible to eliminate human biases. Nobel laureate Daniel Kahneman has spent a lifetime studying human biases. He's won a Nobel Prize for his work on human biases. He says that after all of these years of studying biases, he's not able to eliminate his own biases. The reason for that is, if you've come across an optical illusion, you see an illusion, it's an illusion, but your brain still gets tricked every single time. It's because the human brain is hardwired to perceive certain stimuli in certain manner. That there's nothing that we can do about it just by merely studying what these biases are. Machines, on the other hand, have no such biases. So the machine is consistent, it's bias free, it learns from both its successes and its failures, and it keeps improving over time. That's the edge of using well constructed machines. But at the end of the day, it's not as if that you can do without humans. You still need humans, but you need smart humans. You need humans who know what intelligent investing is. Because a machine is not going to function by itself, it needs humans to guide it. An analogy that we often give is, so if I ask the question, is is a financial model built on an Excel spreadsheet good or bad? You'll say that's an absurd question, because just the fact that it was built using Microsoft Excel does not mean anything. What matters is, what were the assumptions, what were the ideas that were put in those models, and that holds for any technology and AI, ML, Chat GPT, you name it. All of these are just tools, they are just enablers. Eventually, what matters is, who are the people using these tools, how well are they using these tools, that will determine the quality of the final outcome. Another aspect where humans have a very important role to play is to understand and act on fast changing situations which cannot be captured by data. For example, if geopolitical tensions are escalating, or if there is a looming global pandemic, these are places where you need humans with their ears to the ground to understand and act on such fast changing situations which cannot be captured by data. Right. So put together, how we maximize your returns while keeping risk at bay is through a fusion of advanced computing power along with seasoned wisdom that we've accumulated over decades. And this is the heart and the soul of our investment model, our tech stack. We call it the exotech. And it has many different components. Happy to go into specifics of each of these separately, but suffice it to say that each one of these subsystems answers specific questions about the entire investment puzzle. And then all of these insights are collated, put together into one ensemble, one final output, which is then deployed in our various products, be it the India PMS or our global funds. What that means is that every decision we make is backed by data and deep market understanding, ensuring that your investments are poised to grow. And because we value your trust, our systems, our processes work tirelessly to safeguard it by minimizing risks. Talking of risks, this is extremely important. No, our entire risk management paradigm is motivated by something that Charles Ellis once said. He said that investing is a loser's game. Okay? What that means is, in order to win the game, you need to avoid the losses, sidestep the big losses, do not make the big mistakes, and the returns will take care of themselves. So that underlies our entire approach to risk management. We have risk management practices embedded within every single step of the investment process, be it identification of the investment universe, where we look at only the most liquid ends of the market, to position sizing that achieves risk parity, to diversification across multiple dimensions, having a protective stop loss for each one of our positions, to our proprietary tactical insurance for portfolio protection, or TIP for short, where we purchase insurance for the riskiest parts of the portfolio. It's a tactical and dynamic layer of hedges when we perceive great risks in certain parts of the portfolio. So, like I said, our first number one mantra to investments is protect the downside. Do not lose big money. In fact, we say this often: more than half the fees that we charge is for risk management, less than half is for return management. And what that has resulted in is this. During the COVID crash of March 2020, while the markets had fallen 30, 35, 40%, our portfolios in that month lost less than 10%. That's a significant protection in a turbulent time like the COVID period. And more recently, last year, the day Russia invaded Ukraine, while the Nifty was down around 5%, our portfolios are down just 1.6%. So these are examples. This is testimony to the robustness and the rigor of the risk management that we run within our portfolios. Very quickly, moving on to our offerings, we'll start off with our offerings in India. Before I talk about what exactly our offerings are, the principle that we follow is we do not offer a proliferation of products. We do not offer sectorals, thematics, large cap, small cap, all different kinds of funds. We have a very simple lineup of products. The reason for that is as follows. Research shows that the majority of your returns come from top-down allocation rather than bottom-up security selection. So if we offer different sectors, different themes, different market cap bands, and if eventually the decision of where to invest is in the hands of the investor, then what are we being paid to do? Okay, so that's one. And the other reason is a lot of these thematic funds are launched at the worst possible time for the investors, that is after the theme has completely played out. So I mean, there are great ways to gather AUM for the fund management house, but I mean, not so good for the investors, to be honest. So within our PMS,
In fact, let me just give you an example here. Just recently, I was talking to someone on social media about how thematic funds do, and he said, look at, he mentioned, I wouldn't mention the name of the fund house, the technology fund, that look at how their technology fund in over from 2003 has given X number of times returns, and it was the NAV was, I think, 2 rupees, which has become 160 rupees, something like that. And I said, do you realize when that fund was launched? It was launched in March 2001. I mean, timed almost to the week before the tech crash. And that's how, in the matter of 2-3 years, that 10 rupee NAV became 2 rupees. And you are telling me that from 2 rupees it has compounded so much. You're not telling me that in the 3 years prior to that, 80% of the money that was invested in the NFO was wiped out. So that's how most thematic funds do. If you remember, I mean, very recently in 2021, there were all these NASDAQ ETFs and funds, and I was on TV in real time saying that you think NASDAQ has done well for 3 years, it will do well forever. Nothing does well forever. And in less than a year, those were down 40%. So, I mean, this is the thing, and you can track it for every single theme. Tech funds ka buy, pharma funds ka buy, small cap funds are they're always close to the peak of that theme, because by that time people have this FOMO feeling, fear of missing out, that everybody has made money in this theme, I am getting left out. So let me now jump onto it. So one tip for all of you listening in, this is a quote from a Richard Branson book. I don't know whether it's an original of his, saying that never worry about missed opportunities. There's always another bus coming along. So if you miss this bus, doesn't mean that कि life में और कोई बस नहीं आएगी चढ़ने के लिए. So ये बस निकल गई तो अब उसको जाने दो. So you get on to the next one. So and as Sachin was saying, that's our job, to find out which is the next bus to get onto. If I leave it to you, then what am I getting paid for? Because 80% of the returns are going to come from which geography, which asset, which sector you are investing in. Right, Achin, back to you.
right. So very quickly about the products that we offer under the PMS structure in India. We have the India Super 50, which is our equities long only portfolio that invests in stocks listed in India. So we have a minimum market cap cutoff of 1,000 crore. Uh, it invests across all sectors, across all market cap bands, and I'll give you a quick snapshot of where we are invested as we speak. But that's the India Super 50. And then we have the Indian multi-asset allocation portfolio, the IMAP, which is a multi-asset class offering. So the equities part of the IMAP is exactly the same as the India Super 50. And then we have fixed income commodities, basically meant for people who don't want a full equity exposure. Okay, and that's all. That's just the two products that we offer under the PMS. Yeah, and as you can see, this is typical allocation as at the end of September. I think yes, this is at the end of September. So this is just indicative of the fact that we don't have any concentrated positions in any particular sector or industry. It's fairly well diversified, and this is the norm rather than the exception. And in terms of market cap bands, as you can see, small caps defined as anything between 1,000 to 5,000 crore INR, that constitutes 18% of the portfolio. The rest spread between mid and large cap, with the majority towards large cap. So once again, that's something that we are extremely cognizant of. The allocation to small caps will rarely, if ever, exceed 20%. Because small caps look great while they are doing well, but the moment the liquidity dries out, you will not find an exit in a lot of these names. And next, moving on to our offerings in the global markets. So first and foremost, we have our flagship Global Freedom Fund, which is a global multi-asset, multi-country fund. So when we say global, a lot of global products end up investing in the US or China. So when we say global, we truly mean all the large investable geographies of the world, not just the US, not just China. So this is an offshore Cayman Island based vehicle accessible via LRS money with a minimum ticket size of 100,000 US dollars, uh, which invests across all of the entire spectrum of asset classes. So within a single window, you are getting access to all asset classes, all parts of the world. So you don't need to worry about should I be in equity, should I be in fixed income, should I be in developed markets, emerging markets, which sectors, which stocks. All of that is taken care of by us. And so that's a Cayman Island based mutual fund. And then a similar product we offer under a slightly different structure called GMAP. It's a portfolio structure, similar strategy, save a few differences, but the underlying engine is by and large similar. This is offered under a portfolio structure with a minimum ticket size of 10,000 US dollars. That's all. I mean, typically products like this will have minimums of several million US dollars and will require you to have private banking relationships with the top banks in the world. First Global is not just the only firm in India, but truly the only firm in the world that is offering a product like this at an entry ticket size of 10,000 US dollars. So that's like, completely unique. These are our multi-asset global products. Apart from that, we have a couple of asset class specific products. So we have a global equity only portfolio. Once again, this is offered under a portfolio structure. And then we have a global fixed income offering. And all of these global products that we touched upon, the GFF, GMAP, GPEP, GFIP, all of them are accessible via LRS money. Now, there's another suite of products that we have for global markets, which are available to non-LRS money because they rely on a bit of leverage. We trade derivatives, so you cannot send money via LRS and invest in those products. If that is of interest, we can take those separately. We are not spending time on that in the broader interest for this presentation. Right. Uh, about First Global, First Global has been known for decades. I mean, we've received front page coverage on the Wall Street Journal. Alan Abelson commended our research in his column in the Barron's. We got extensive coverage when our fund sidestepped the COVID crash in 2020. And most recently, Devina featured in the Fortune list of the most powerful women in business in India. In fact, she was the only woman from the world of investing to make it to this list, and we are all immensely proud of this achievement. And in terms of our vintage, these are some of our decadal calls. So on the left, you see our coverage on Amazon. So after the tech crash, the world had written of Amazon. Business Week came out with a cover saying, "Can Amazon survive?" And in that same week, we came out with a strong buy on Amazon. And First Global was the only firm to have a buy, let alone a strong buy, call on Amazon at that point in time. And Jeff Bezos sent us an email thanking us for the support. And we know what happened over the next 20 years. On the right, you see our coverage on HDFC Bank from June 1996, 1 year after its IPO. So the cover shows a baby transforming into Arnold Schwarzenegger. That's how First Global saw HDFC Bank way back in 1996. And like it's mentioned, Devina received recognition for being one of the most powerful women in business in India. about the team, so obviously Devina needs no introduction. She's a stalwart with more than 30 years of investing experience. She holds a undergrad degree in maths, stats, and English from Lucknow University, where she won 8 gold medals, and then she was once again a gold medalist at IIM Ahmedabad. I have the privilege of heading the quant research team. I have a BTech in computer science and engineering from IIT Kharagpur and an MBA from IIM Bangalore. Alok, who's here on the call with us today, he has been a part of the organization for more than 20 years, and he's played an instrumental role in developing a lot of the systems that you saw on that exotext slide. Kavita, once again, a part of the call today. She heads fundamental research, once again, been a part of the organization for more than 20 years. A lot of the global media coverage that you just saw, a lot of it was Kavita's work. And of course, the team is much more than what you see here. We have some very, very talented and bright individuals, both in the fundamental and the quant teams. And on that note, I will hand back to Devina to talk about some of, people all keep making a lot of big calls. Okay, you see, you turn on any business channel and you'll see all pundits making predictions. But how many of them actually go back and take a stock of the predictions they've made? We stand by what we say. We always believe in accountability. So over to you, Devina, to talk about some of your big calls over the last couple of years, please.
Yeah, thanks, Sachin. Yeah, so I mean that's the thing. So when people ask me, अभी तो नया नया संवत शुरू हुआ है ना कि अगले साल सेंसेक्स क्या होगा या निफ्टी क्या होगा, or they ask me in January. For 30 years, I have never ever given a Sensex or Nifty projection. Now I have the theoretical basis to say why you should not do it, because it is not only something that you don't know, it is something that you can't know. So जो भी आपको कोई projection देता है, my suggestion is you write it down and check at the end of the year how good or bad they are every year. And the results may surprise you. So just because someone says something confidently on TV or wherever doesn't mean that they are competent enough to make that projection. And as Achin said, that we stand by our projections or predictions, and it's not as if we'll be right 100% of the time. But since our whatever we say, when we say it is based on data, there is more than a fair chance of it being right. So rupee depreciation, of course, now the rupee has depreciated, but let me tell you, 2 years ago, nobody thought of rupee. Currency wasn't even on anyone's horizon of possible risks or things which could change. And this, I'm talking from the end of 2021. I said it very unambiguously that in 2022, for certain, you will see the rupee depreciating. Rupee had been, if you remember, in that 75, 76, 74 kind of range for years. And there were a whole lot of data that supported that call of mine. Because in macroeconomics, we all want that everything should be good. Growth should be good, inflation should be low, interest rate should be low, currency should be strong, and so on. But you can't control all the variables. And given the choices that India was making, and because we were tracking global data, so see, this is the other thing. Like in 2021, people thought कि Fed ने भी rate नहीं बढ़ाया है और RBI ने भी rate नहीं बढ़ाया है, so we are all on the same page. But people were not tracking that most other emerging markets had already started to increase interest rates in 2021. They had raised it 2, 3, 4, even 5 or 6 times, and India had not even started. So that was a clear going to be a pressure on the rupee. So this was, and there were other factors also. There's a whole video made at that time where I laid out all the factors. So rupee depreciation, of course, happened. But on the other hand, we'd also said that India would outperform. And again, this was based on data. So, I mean, Harbir in the beginning talked about whatever uncertainties relating to the economy and so on. But one thing you must always remember is that the economy and the market are not the same thing, and they don't necessarily move together, especially in the same time frame. At the very least, there are leads and lags. So if I want to give you an example on the other extreme, the Chinese market made its peak in 2007, and after that the economy went up 6-7 times without the market taking out that high. So you cannot just extrapolate that economy is doing X and market will do therefore be in the same direction. So coming back to the Indian market, we all have this figure in mind that the Indian market compounds 15-16% because that's been the long-term compounded annual growth rate. But what people do not realize, again, we think equity is a volatile asset class, but we don't realize that how volatile it can be, how much the returns can vary. So 1980 में अगर आपने पैसा लगाया होता तो in 10 years by 1990 100 rupees would have become 700 rupees. If you had invested that same 100 rupees excuse me, in 2010, in 10 years, it would have just become 230 rupees. In that decade, the market compounded only about 8.8%, which was hardly any premium over the fixed deposit return. So from that kind of, 10 years of subnormal returns, when it started to outperform, I knew it would last for a while. So again, this was a call we made that it will outperform relative to the globe, which it did last year, and that it will outperform relative to the recent history, which also it did. Now, this IPO frenzies, again, we've seen the data over a very long period of time. They come and go, and not just in India, all over the world. I mean, the last data I saw was Paris in the 19th century having an IPO frenzy. जब वो जो सड़क पे the food vendors were also handing out prospectuses. So India में भी ऐसा बहुत बार हुआ है. I was reading this book which has the history of the market in the 90s and all that. And there were years when more than 1,000 companies IPO'd. There were, I think, 2 years when more than 1,000 companies IPO'd. And now if you see the entire listed universe of where even 500 shares are traded every day, just about 4,000 companies. So a lot of the companies that IPO go out of business. So that's something, again, you have to remember when you're talking about the prospect for the market. So when I said the market still looks okay, that's for the large caps. Small caps, I will just talk about separately. So coming back to the IPO frenzy of 2021, I said it again at the time, not see in hindsight. तो आपको कोई भी कुछ भी बोल देगा कि हाँ मुझे तो पहले ही मालूम था. But you see my videos of that time. I remember there was one on ET Now where Nikul Dalmia asked me that if I put a gun to your head, Devina, which IPO will you buy? And I said none still. And I'd also laid down the reasons why. Because see, anytime you are trying to say that instead of PE or instead of price to book, or let's look at some other kind of ratio. Or let us look at, instead of looking at 2 years out earnings, let me look at 12 years out earnings. Once you start doing that, you are not doing a valuation, you are only justifying a valuation. So I was very clear those so-called new age IPOs are not going to go anywhere, and which is what happened. In the last 1.5 years, twice I have made, and this is again on record, it's there on my Twitter also, I have said twice that this is clearly the time to invest. One was June 2022, and later on I saw the index was about 15,300, the Nifty. In March 23, when again I made that call, and no ifs and buts. I said I don't know whether it's the exact bottom, but it is in the range, and the index was less than 17,000 then. So when people tell me कि आप बताना कब इन्वेस्ट करें, मैंने कहा मैं बता भी दूं. आई एम नॉट सेइंग I'll be right all the time, but I'm saying मैं बता भी दूं तो आप एक्ट करोगे क्या? So what happens is that when there is uncertainty, I talked about that missing that 30 best days in the beginning. Now those best days don't come in the bull market. This is the surprising thing, maybe to some of you. When the market is in a bull market, वो एक दिन में इतना बड़ा move नहीं आता है. That big one-day move comes in a bear market, or when there is uncertainty, when people are sitting on the fence, not confident, the kind of thing Harveer spoke about in the beginning. So that is the time that sudden big move comes, and if you are not invested, you miss it. So as I said, that I thought the best time to invest was this March 23, but if you have not invested, now is also not a bad time, provided you choose the sectors carefully. And if you want to stagger it, you can stagger it over 2-3 months, but it's not a bad time at all. I mean, not to say that there cannot be a 4% or 5% correction from here, but in the longer scheme of things, that in any case in equity, you should not invest with a 3-month, 6-month kind of horizon. And neither should you keep changing your asset allocation. This is the other thing that often लोगों को लगता है अरे अभी तो गोल्ड ने अच्छा किया, पिछले 6 महीने गोल्ड में होते तो अच्छा रहता, or a few months ago it was in the past 1 year the fixed income has given higher return, so why was I in equity? So you can't keep doing that. That way you will miss out on the big move. So do a sensible asset allocation and kind of stick to that. Yeah, next slide. And this was also, this I briefly mentioned, that when all these NASDAQ funds were coming, I was on TV at that time saying that this is another bias called recency bias, where you just extrapolate the recent past. And I said, NASDAQ has done well 3 years. You think it will always do well? Nothing does well forever. Russia, Ukraine, the day the war broke out, when people thought the world was coming to an end, I had made a video and I was on TV and I said, this will be forgotten by the market sooner than you know. Because we looked at, again, data. We went back 40, 50 years. We looked at every geopolitical upheaval. The US bombing Libya, the two Gulf Wars, Afghanistan, 9/11. And in every single case, the markets that were not directly impacted, like in this case, Russia and Ukraine, ka to khair market is directly impacted, leaving aside the actual combatant. Nobody else was impacted 6 months or 1 year later. So I said the only impact, because Russia and Ukraine are big commodity players, will be what happens to commodity prices and how that impacts the fundamentals of certain companies. But otherwise, this overall impact will dissipate, because otherwise, always it happens that around that incident, before and after, there is turmoil in the markets and then it just scrolls off. And on the other hand, the wars themselves don't get over. Now, this is the thing, that the impact on the markets is very ephemeral, but the wars don't get over, even though the adversaries may be very mismatched. You would think कि US को कितना लगेगा to crush Vietnam or an Afghanistan, but nobody gets out in 2 weeks. It just stretches on. But हम लोग का तो the view is very narrow. So from that narrow view, that impact on the markets goes away. So if I look at the situation in Israel and Palestine today, I mean, as a human being, I am extremely pained to see thousands of children dying, to hospitals being bombed, and really, I mean, war crimes being committed. There's no other way to say it. But will it have a huge impact on the markets? I don't think so. So crypto, again, look at data. Even though crypto, there's no great 50-year data, but even the Bitcoin ka data jahan se bhi available tha, you could see that there had been multiple drawdowns of 70%, 75%, almost 85% also at the time when this whole euphoria of crypto was going on in 2001. And we said that, and at times we did have very small holdings in crypto assets, not cryptocurrencies directly, but certain other crypto assets. But that was only in a very diversified portfolio, where we felt at times that there was a negative correlation to some of the other things. But overall, we were clear that this was a very volatile asset class. And in 2021, I had written multiple articles on crypto, and all of them said that this is the history of the drawdown. So, if you're investing, you should know this is that you can have drawdowns of 70-80% in this asset. So that's it. Of course, not to say that everything we say comes out to be right. Like, for example, last year we thought the probability of a US recession was relatively high, which hasn't quite panned out till now. But we also were very clear last year that while a lot of people were predicting that this year, that means to 2023, the Fed would start to cut rates, we were very clear that that would not happen. And again, that came out of a study of history, that anytime inflation becomes this high, it does not come back in 2-3 quarters. It takes a far longer time. So, I mean, we were clear that there was not going to be a case where the inflation would come down enough for Fed to actually start cutting in 2023. So, that's the way we like to do it. We look at all data. And one thing, of course, the products Sachin spoke about, but one thing I would like to tell you people is that we actually had the PMS license from the time the PMS guidelines came out in, I think it was 2000 or 2001. But we didn't launch a product for 20 years. And the reason for that was that I felt that I can take other people's money, your hard-earned money, only if we had a systematic approach where there was some predictability, where it was not just dependent on my judgment, however good I think my judgment is. So we waited till we had a system and then we launched a product. So as I was telling somebody that I am a first principles thinker, I don't mind being the first in something. I don't mind being the last in something. Like we were the very first, not just the first Indian firm, but the first Asian firm outside of Japan to go international. So we were the first Asian members of the London Stock Exchange and the NASD. This is 99, 2000, as far back as that, when everyone told me that it can't be done. Who's going to listen to you when they can get research from Goldman Sachs and Merrill Lynch and Morgan Stanley? Why will they listen to you? I said, if I know how to do it, they are going to listen. So I didn't mind being the first there. I didn't mind being practically the last to launch a portfolio product, because I wanted to be certain I can do a good job. And if I can do a good job, that's when we launch a product. So that's why since we launched, we have done as well as we have. And that's coming out of a system, which is why you feel comfortable saying that there is some predictability to what we are doing. So, I mean, coming back to that Kya Lagta Hai Market. So I spoke about the large caps a while back, but let me just, before handing it back to Harbir and his question, let me just also give you a little bit of history. I mean, I'm always talking history and data on small caps. So on small caps, the thing is this, and especially this is, many of, I think some of you are advisors, that many of your clients may be new to the markets and may not have this perspective as to what is the risk of investing in small caps. I just mentioned that how many companies get listed and how many survive 10 years, 20 years later. That's one part of it. So if I look at the small cap index in 2008, from the highs it made, it fell nearly 80%, 78% to be exact. And then the 2008 index number was next reached in 2016. That's one. After that, वो 1.5 साल का bull run फिर से आया था small caps में. Then 2018 again, the index fell nearly 2/3, 65% it fell. So now, often people do not understand this basic mathematics, that percentages are not symmetrical. So in the COVID crash, if your fund went down 33% or 35%, you need to rise 50% to come to zero. So when the small cap index fell 80%, it can go up 5 times and you would still have zero returns. Similarly, when it fell 2/3, it can triple and you will have zero returns. So now I find some small cap fund managers or advisors or micro cap advisors saying, oh, I have compounded 60% in the last 2 years. But this is the point, that if you are down 2/3, you can compound that and still not even be back to zero. So be very careful on that. That's one. Number two, people will say, "Okay, wo to index hai na, I'm choosing the stocks very carefully and I will do very well." So how many small cap stocks did not fall in the 2008 crash? 1%. In the 2018 crash, how many did not fall? 8%. So, I mean, how likely is it that you are going to be that superb, amazing fund manager who will pick up those 1% stocks which are not going to fall? So this is stupidity, I would say. And the third thing is this, that even when I say that index came back to the 2008 levels after 8 years, that was not even the same index, because small cap index churns 18-20% every year. So in 6 years time, it's a new index altogether for the most part. So keep all this in mind. So the bottom line in this, that small cap is a risky end of the market, so limit your exposure there. We in our PMS rarely will go above 20%, at the most 22-23%, when our systems show that small caps are doing very, very well, because that's an inherently risky area. And also, while things like, for example, stop loss help you, in a small cap that may not even help you, because once those stocks start to fall, there is really no exit. It can fall very rapidly and you may not be able to get out at all. So that's the framework. Harbir, back to you. So what specific questions would you like me to address?
Thank you so much, ma'am. And even with your viral, the energy was evident. Something which was pretty evident in your energy, and the knowledge that you've shared is something priceless. Incidentally, you mentioned about the tech fund, and we have with us Chetan Gill, who probably the only person I know who made money out of that particular tech fund. Incidentally, he's going to take forward the Q&A session with us today. My old friend and colleague from my Standard Chartered Bank days. I would request Chetan to please take over the Q&A session, and whatever questions we have, let's get an answer to them from ma'am.
Yeah, thank you, Harbir, and a warm welcome to Devina ma'am. Ma'am, I would just say that yeah, Harbir was saying was true, but then I became conservative because then I didn't want to bet too much. Having seen the markets going down in the tech boom by 80%, I got a little conservative. But like you said, there are many if you miss one bus, there are many other buses which may come along, or many other trains that we can catch. Sometimes it can be a super fast train like the tech boom, which within a year and a half or two was like an express train, and sometimes there are slow moving trains. But obviously, each one can take it according to the asset allocation or whatever. But ma'am, looking at your profile, it's a brilliant profile. You've been a gold medalist. You identified HDFC Bank at rupees 38, which I think X split and all would be 3 rupees or 4 rupees, a 500 bagger. You identified Amazon at $15, X split at $0.75, again a thousand bagger nearly. And I think Jeff Bezos wrote a mail to you when you initiated the coverage when other firms were not initiating any coverage on the Amazon stock in 2001. But now at this point of time, like we got so many reports which say that India has had the maximum number of multi-baggers in the last 20 years because it was a developing economy. So maybe the small caps, mid caps, or grew to large caps. And so what would you say for the next decade or 2 decades? Is it going to be India's decade, or are we going to get more multi-bagger in the US because they have AI, they have technology, they have Microsoft, they have... What would you say to that?
Well, first of all, I would like to say that India, I told you the last decade, actually the 2010 to 20 decade was a very subnormal decade. It was not a good decade at all. So if you look at compounding for a whole decade, in the 80s, you compounded at 21%, next decade at 14, next decade at 17, and this decade you compounded only 8.8. So it was actually a very bad decade. So that's that. This, I don't know what data you would be looking at to say that it was a great time for India. It wasn't up to 2020. After that, of course, we have done well. But even then, because of how the globe has been, it is not as if that you've got great compounding still, which is the reason why I'm saying the risk of a crash is not very high, because the risk of a crash really comes when you're way above the trend line. You've not even come to the trend line yet. The other thing is that people ask me, you gave the names of HDFC Bank and Amazon. And Amazon, it's not as if there was no coverage. Everybody was an Amazon bull till at one point they just gave up. So Mary Meeker, who was the biggest bull on Amazon, wrote a report throwing in the towel on Amazon, saying that it will go bankrupt now. Whereas I don't know what they were smoking or what data they were looking at, because that was the first quarter when the cash flows really zoomed for Amazon. I mean, our call was solely based on that in the last quarter of 2000, their cash flows were $220 or $240 million. And said, like, for the first time, they're really now making cash and there's no risk of it going bankrupt, when people were saying the reverse. So that apart, but people tell me today, I keep getting these mails, I've got a small baby, which is the HDFC Bank or Amazon you will recommend today. And I said that if anyone tells you they have this magic wand of telling you of which will be the multi-bagger, they are the biggest liars, because no fund manager or no investor in the world, no meaning no, have got a track record where their portfolio consists of not just 100% multi-baggers, but even 80% multi-baggers. It is No one knows in advance which one is going to be this thousands of % compounder. At the most, when you are recommending something, you can see the stock might double or triple. उससे आगे की visibility किसी की नहीं होती है. आदित्य पुरी और जेफ बेजोस को भी नहीं मालूम था कि this is going to happen. So there's no way you can know the trajectory, given that, see, investing in life in general is a game of skill and luck. You can call luck, destiny, God, jo bhi bolo. It is not skill alone. And what is going to happen is always a range of probabilities. So you are playing the probabilities. And the reason why we diversify is that if you have a certain skill, and skill doesn't mean 100% hit rate, but if you think you're going to be right 60% of the time or 70% of the time, by diversifying, you're ensuring that your hit rate is close to that 60-70%. Otherwise, you're only playing luck, which might help you in 6 months, 1 year, which is why, I mean, sometimes we have people coming to us, I invested in that XYZ fund or PMS. वो 2 साल बहुत खराब किया, पिछले 1 साल से बहुत अच्छा कर रहा है, और vice versa, because they are doing something in particular which, when that theme comes into fashion, you will do well for a while. But that's not the way to make predictable returns. So, that's the thing. So I don't know in advance. No one knows in advance which companies are going to be the multi-baggers. But if you choose carefully, some still will be wrong decisions, and you should, which is where the system helps, that you recognize, yes, this was a mistake and get out, or that there's something better available and you get out. And of the rest, certain will give you normal returns. Certain will give you, if you've chosen well, maybe out of 25, 2 or 3 might turn out to be multi-baggers, but you will not know in advance. इसके लिए मैं एक और आपको बताऊं, ये सब जो आप कोई भी रिसर्च रिपोर्ट किसी भी कंपनी की उठा लो, उसमें अगर जो फाइनेंशियल मॉडल होगा, डिस्काउंटेड कैश फ्लो होगा, उसमें आप देखोगे हर साल ग्रोथ है, अगले 5 साल भी ग्रोथ है, उसके बाद टर्मिनल वैल्यू में भी ग्रोथ assumption है. I told you there are 4,000 plus companies listed in this country. How many do you think have shown some growth every year for even 10 years? 10 साल कोई बहुत लंबा समय नहीं है. So for even 10 years, how many companies out of those 4,000 have shown just G greater than 0 every year for 10 years in a row? आप किसी भी कंपनी का 10 साल पहले का रिपोर्ट उठाओगे तो आपके प्रेडिक्शन में growth ही growth होगा. Unless the company is currently loss making, there will never be a situation where there will not be some growth shown every year. You guess how many there are? Or there are only about 17 companies which have, even for 10 years. For 20 years, last year when we did this exercise, there were only 2, HDFC Bank and Supreme Industries. और इस साल Supreme Industries का भी profit decline आ गया. So even that's gone out. So it's as hard as that. And people who are telling you that they have visibility for 10 years, 20 years are only telling you stories. Stories आप सामने वाले इंसान को कन्विंस कर सकते हो, because human beings, again, this is a very hardwired bias in us that we love stories. In fact, stories, you can say, is what makes us human. No, अभी मेरे को ये प्रॉब्लम होती है, like you are even getting empaneled with a bank, let us say, for distribution, and the bank investment team will say, can you tell us the story why you are holding these stocks, or which are your high conviction ideas? I said our whole system is against high conviction ideas. We don't want to have high conviction ideas, because the high conviction ideas means you will not enter and exit at the right time. 2020 or 2021 mein our best performing stocks were some of the chemical stocks, which, as you know, did so well in that period. But jab uska time khatam ho gaya, we got out. If we had built it up in our minds that this is the best business and the best managements to be in, we wouldn't have gotten out. Or abhi, for example, people have started talking of this manufacturing and capital goods story in 2023. Our systems liked it in 2021. So we have been overweight that sector for over 2 years. And the question which we very objectively ask every quarter is the story over? So we don't want to be sold stories, and we don't want to sell stories, because that systematically brings down your returns. मतलब जो लोग FMCG का गाना गाते थे 2020 में, वो ITC को नहीं देख रहे थे. Whereas when our systems like the first FMCG stock they liked was ITC, and we bought it, and it was like a top performing stocks for a good 1.5 years. जब तक जो FMCG वाले लोगों ने तो खरीदा ही नहीं वो. So I mean, stories always create a problem for you. So we don't want to sell stories or buy stories. That's why we go by data. So data means on the same criteria, on a bias-free, noise-free basis, you're looking at all stocks and choosing from all stocks.
Yeah, thank you, ma'am. No, I just reframe the question. It wasn't that India has done the best on the indices. I was saying that the report suggested that India has in the NSE 500 or the top 500 stocks, it has the most number of multi-baggers over a 2-decade period. But then, obviously, the base we were taking was 2002 or 3 when Indian stocks were quite beaten down, like you said correctly earlier.
You can choose and come up with anything, because see, 2003 to 2007 was a great period for emerging markets, including India. Pura emerging market index 3.5-4 गुना हो गया. India went up 6-7 times. Brazil went up 10 times at a time when US was still struggling and could not come out of that post-tech crash depression. So that's just a matter of carefully choosing another entry point. You can show the reverse figure. So that's not a very meaning, because uske pehle, the 2003 se pehle kya hua tha, 94 to 2003 India had a net zero return. तो उसके बाद वो जो 4 साल में बड़ा रिटर्न आया. So I was talking somewhere about Rakesh Jhunjhunwala, and I said people think कि Rakesh Jhunjhunwala's skill was stock picking. It was not really stock picking. मतलब he picked hundreds of stocks, उसमें उसका पैसा 3-4 में बना. But his real skill came out in that book. I mean, this was just a throwaway line in the book, but to me it was the crux of the book. He said कि I made a lot of money in 89 to 92. I made a lot of money in 2003 to 7. But in between, there were even 5-year stretches where I didn't make any money. So the fact that he understood and could live through that equity returns are lumpy. और होगा ऐसा कि आपको कुछ रिटर्न नहीं बने for many years and suddenly then वो 3-4-5 गुना हो गया in 2 years. So that's the nature of equity market. So if you don't panic and you really internalize that and you can live through that, I think that was his skill. रिटर्न लम्प्स में बने और लॉन्ग पीरियड जब रिटर्न नहीं भी बने तो आप मार्केट छोड़ के भाग नहीं गए.
Ma'am, you are a gold medalist in stats, so I'll give this question in a different way. In the next decade or maybe 2 decades, is there a high probability for India to do well? I'll keep it on a probability scale.
See, वो एक तो मैंने कहा कि India doing well and the market doing well are also not coincident. I told you कि the Chinese economy went up 6.5-7 times without the market taking out its high. इतना बड़ा gap था. So as far as Indian economy is concerned, I have some concerns. One of them is, which actually arises out of the fact that we talk of our demographic dividend and our young population, but demographic dividend, you talked of statistics of demographic dividend के 3 component होते हैं. First is that number of young people, number of people in the working age population, into how many of them have got jobs, into the productivity. So we have the first one, but हम लोग तो second पे ही falter कर गए because we're not able to find jobs for the young people. So unless we do that, structurally, it is very hard to move up to the next income level as an economy. However, on the aggregate, things are looking kind of good because there is this, there is like a 2-tier economy. So which is why the people like you and me will say, अरे पर हमारे दोस्त तो नई गाड़ी खरीद रहे हैं, नया घर खरीद रहे हैं, because everywhere the luxury end or the affluent end is doing well. Luxury homes are selling. Affordable housing loans have been stagnating, I think, for 5-6 years or something. Again, in cars, high-end SUVs are selling. Entry-level cars volumes have actually shrunk, even in this July to September quarter. 80 crore Indians need free rations. So all of that shows that there is stress in the economy. Now, the listed space is a subset of the economy. So, जैसे आप real estate को ही ले लो, जो listed real estate firms and they mostly deal with the luxury segment. तो उनके लिए हो सकता है अच्छा ही चल रहा हो, but I'm saying therefore economy and markets can be two different things. I remain, as I said, positive on the markets, except certain segments. जैसे अभी मतलब अपने को banks, which is the highest weight, doesn't particularly look good to me. ये अलग बात है कि somebody said कि आपका तो तकिया कलाम है कि I am a nervous investor in banks. मैंने कहा ये बात ठीक है. You know, banking is a high risk sector. So so I mean, economy, in order for it to really all that promise to fructify, there are a lot of things to do. In fact, आज ही मैंने tweet किया था कि this thing about that India will grow far faster than China and all the foreign investors will have no option but to invest in India, etc., etc. And I said, you think this is a synopsis of today's headlines? This is a description of a New Year party in the 2007-8 New Year. So it was like, I was reading a book, and then that, it was a description. It was like what people were saying in that New Year party. And so, as I said,
sorry, I have interrupted you. A brilliant point you made. Sorry, I think your audio is lost. Yeah, one earlier brilliant point you made, ma'am, was that predicting
what are you saying?
Predicting growth over the longer term is very difficult. Like you said, only 2 companies have grown at a certain compounding rate over the last 10 years.
Greater than zero, not even a certain compounding rate, at greater than growth greater than zero every year. That's all. Not even, there's not even a 1%, 2% benchmark I'm talking about, just greater than zero.
Another fund manager had just quoted this book, Built to Last. They said it was written in the 90s, and it had said that in the US, companies like GE and IBM will continue to grow, but 20 years down the line, those companies are nowhere in the index. So he said there is a series of long-term is a series of 1 to 3 years when we take a call on a stock, and after that we keep reviewing the results and all.
Right. So in fact, ये जो दोनों books थी ना, In Search of Excellence and Good to Great, you see the companies featured there in the next decade, they hugely underperformed, and I'm not even talking the stock prices. उसमें तो आप बोलो कुछ और भी consideration है. Even on the fundamentals, they underperformed the S&P. So this is all fairly random. You all must read this book called The Halo Effect, which is precisely this कि जब अच्छा कर रहा होता है तब उस कंपनी की सब चीज अच्छी होती है. Like, I don't know how many of you remember, but Cisco at one point was the highest market cap company in the world. And ABB at one point in Europe was a very doing very well. And everywhere it would be, once you're doing well, then most admired company, you will be there. Best place to work, you will be there. Everywhere you will be there. And as soon as the performance starts to falter, वो same story उल्टी हो जाती है. That पहले it is that the CEO is very decisive. When it's not doing well, then it is that the CEO doesn't listen to anyone, and that's why it's not doing well. So the same qualities, you can look at it this way or that way. So a very eye-opening book called The Halo Effect, which is that when things are doing well or badly, then everything gets tinged with that. That's why, I mean, data is important, because as human beings, that's the way we like to do. I mean, that's a natural tendency. ये management अच्छी लगती है, इसलिए सब लोग ये सब ठीक ही करेगा. That's how you make those stories in your head and you act on that.
Thank you, ma'am. Before I just go back to my colleague Habib for another question, I just had one more question for you, in the sense of ये जो एक retail anecdote है जी अमेरिका का, which says that when the shoe shine boy says you should buy stocks, you should leave the market. That was in the Great Depression of 1929. And similarly in India, when the pan wala, the rickshaw wala started buying in the Harshad Mehta boom or the tech boom, people used to say you need to get out. But अभी यही retail person हमें fit में strength दे रहा है, हमें but their majority flows are now coming into the small and mid cap. So what would you like to comment on the maturity of the retail investor in India at this point of time?
So I spoke about that a while back, which was exactly this. People are new in the markets. They don't know the history of how risky small caps can be, which is why I gave all that data about what happened to small caps in the past. Because people coming in do not have that perspective that this is the kind of money you can lose in small caps. So I was looking at the mutual fund flows, and it is like there's a net outflow from the large caps and a net inflow into small cap funds. And many small cap funds where the fund manager may have been investing only in 100 stocks is now investing in 200 stocks because paisa itna aa gaya to lagana padega, which means that in all probability you are diluting the criteria also. So all this is like signs of potential trouble. So as I said, be very cautious when investing on that side of the market. And of course, there might still be new schemes and funds trying to raise money for this segment, because for them the game is to increase their assets under management, not necessarily the returns that the investor will make.
Ma'am, it reminds us of tech boom when there were a lot of tech IPOs and tech NFOs in mutual funds, and there were a lot of shares which came out.
ये आप गांठ बांध लो कि thematic fund in majority of the cases will come near the peak of that theme, because तब वो बिकता है, तब वो इस level तक आ गया. You were talking about the shoe shine boy, so it is not just like the shoe shine boy giving you the tips, but वो जब तक वो रिटेल पर्सन को ऑन द स्ट्रीट ये समझ में आता है कि नैस्डैक में बहुत बड़ा रिटर्न बन रहा है या स्मॉल कैप में बड़ा रिटर्न बन रहा है, तब तक वो थीम का मोस्टली गेम हो जाता है. इट इज गेटिंग क्लोज टू द पीक. As I told you, that tech fund, which is from one of the very large fund houses, came out in March 2001. I mean, literally days before the market crashed.
Yes, ma'am. But ma'am, on mid caps, you have spoken about being negative or a little bit on small caps because of the valuations, and all small caps cannot be viewed similarly. But on mid caps, do you have a more constructive view?
You see, ऐसा खाली we can't just go by market caps. So you have to really look at the sectors and the companies. So ऐसा मतलब saying कि mid caps will do well and small caps will do badly, it's like that's in a sense an artificial categorization. So you have to be careful. You have to look at the sectors. You have to look at the stocks. So I wouldn't like to give a blanket thing. I'm just saying that as you keep going down the market cap ladder, the risks go up, including the risk that you will not be able to get out. SBI या Reliance पे आप stop loss लगाओगे तो at least you know कि वो stop loss में निकल तो जाएंगे ना. If you do some small cap, वो भी कोई guarantee नहीं है. तो वो circuit to circuit ही नीचे जाएगा and you would not be able to get out.
There will be some youngsters also with us in this webinar, and there will be younger people also who follow people on Twitter, the FNO people, and there's so many celebrities who try to show their profit snapshot, and then there's the crypto, then the Bitcoin. So in that context, I would like to give an anecdote of maybe perhaps one of the greatest traders in the market called Jesse Livermore in the US market. And I think in 1929 Great Depression, he had shorted the market and he made more money. He could buy the entire Manhattan, but later on he kept trading, and I think in the end he committed suicide and all. So what would you like to say to the younger people on this webinar about trading and future and options and cryptos also?
Okay, a few things I would like to say. One, manage risk, which means that even before coming to the equity markets, I'm saying don't go from one end of the risk spectrum to the other. So like in 2021, I saw, especially during the lockdown, that people who had not even invested in equities ever suddenly started to trade in crypto and trade in derivatives, as you mentioned. Even रात को जाग के Robinhood पर US market भी trade करेंगे. So don't do that. So it's your hard-earned money, so or your parents' hard-earned money, someone's hard-earned money. Don't do that. And I saw it not just with youngsters. I saw both people who had finished college, hadn't got a job yet, as well as people who had retired, suddenly discovering this day trading as a great activity. And all of you by now hopefully would have seen that data also, which says that 90% of the traders do not make money, make losses. And the even better data is of that 10% also the average money made is 50,000-60,000 rupees a year. So wo bhi aisa nahi ki they are making some crores. So it's a useless activity, not for anybody to get into. So don't get, and of course now you would have seen some of those people who were hawking courses. See, I mean, anyway, अगर तुम्हारे पास ऐसा कोई money making formula है, तो तुम ये 2,000-3,000 का कोर्स क्यों बेच रहे हो? फिर बनाओ का पैसा और घर जाओ. No, why are you spending your time doing this? Then ये समाज सेवा कर रहा है क्या? What do you think he's doing? So this is so we abhi Diwali nikli hai. This has always been my Diwali sandesh ki it's not just about worshipping Lakshmi Ma, it is about showing respect to the Lakshmi in your house. So showing respect to your money and managing it carefully. So don't be at either end of the risk spectrum. On the other hand, don't delay starting your investment journey, because you can put those numbers in a calculator, but the fact is that if you start at 5 years later, you will have to put in much more money in order to compound to that same whatever is your target number of crores at retirement age, and whatever that retirement age is. So if you start at 29 instead of 24, the difference is high. Even if you start at 45 instead of 40, the difference is high. So start, and start means do a asset allocation. The important thing is, some people freeze that I don't know how to do this. So first of all, of course, now there are resources available to educate yourself. But besides that, the main thing is that get your asset allocation, how much in equity, how much in fixed income, how much in gold, real estate. And even before saying how much should I put there, know where you are today. आधे लोगों को तो यही नहीं मालूम होता है कि what is my current investment, just fixed deposit में कहाँ क्या पड़ा है, कहाँ mutual fund में क्या है. So just tally it all up, see how much is in each category, and are you where you want it to be, or do you want it to be different? If since you're talking youngsters, sometimes you might find कि abhi I can't save much. So save what you can. So maybe you can save only 10% of your salary just now. So do that. But then say कि मेरा जो अगले साल increment आएगा ना, उसमें मैं 80% इसमें डाल दूंगी. So of the incremental, start saving more and more, even if out of your, instead of just upgrading your lifestyle. So put a greater part of whatever your income increase is into your savings and investment pie. So those would be some of my tips.
Yes, ma'am. I'll just come to the audience question, ma'am. I'm doing it on a random basis. So Mr. Davesh Bansal has asked that what is overall view about Indian equities if we all see a repeat of 2004 in May 2024? After 20 years, like if India is winning the World Cup again, are we going to see a repeat also of the election fiasco in May 2024?
So I don't know what he's asking, because in 2024, just after the election, the market fell and then it zoomed thereafter. So, so it's not as if after 20 years, because that election result was a shock to the market, because no one had expected Congress to come in, and it did come in, and so it was the immediate reaction was a crash. I don't remember the exact number of days, but thereafter the market recovered and then went on to zoom. So I don't think we can look at कि अभी 20 साल हो गया तो exactly वही होगा या नहीं. But as I've told you that I am generally positive on the markets, or at least on the large cap side, and the small cap side more cautious.
Ma'am, fair enough. Ma'am, there's a question from Mr. Varun Pal. He's saying, what is the fair CAGR a retail investor should be looking for a decade of investing from here? I mean, a decade for 10 years.
And the problem in the equity markets is this, as I told you, that if you look at each decade's compounding itself, it has been that different, that 21% in the 80s, then 14%, then 17%, then 8.8%. So that's the kind of variability you see. So, I mean, very difficult to say. Long-term compounding has been 15-16%. So if that's any kind of benchmark, maybe that's what you should expect over a period of time.
Yes, ma'am. And ma'am, there's a question, a follow-on question from Mr. Ranjit, whether index funds are good products to invest for a long period instead of going into active funds? There's a passive versus active debate again.
Okay, so one thing I would like to say that people have this inherent mindset that passive, because of the name, is less risky than active. But actually, I have a different viewpoint. But of course, it depends on how your fund manager manages it. And my viewpoint is that the main value that an active fund manager adds is risk management. So when that COVID crash comes, and if you are in an index fund, depending on which part of the world you were in, you would have been down 35-40%. If your fund manager was capable of managing that fall better, like we did, so both in our India and global products, we were down only 8-10%. So if you are capable, if your fund manager is capable of that, that's really saves you. I mean, that really gives you the outperformance points, because if you are down 35-40%, you have to go up 50-60% to come to zero. If you're down only 10 or 8, then you only have to go up 10-12% to come back to a base. So that's the value that a fund manager should add. Now, I mean, the fact is that a lot of fund managers do not outperform. And the reason, as we had said, was because they are still stuck in the 90s and they're still doing things the old way. And now, of course, this is something I predicted a few months ago, that you will soon have funds saying that we use quant or we use AI. But just saying it and actually doing it rigorously are two different things. And we have been using this human plus machine sort of tagline for a while, and I have seen at least 2 funds and schemes come in saying man plus machine or man with machine. I said, jo log 3 word ka title nahi soch sakte hain original, you think they're going to do the original work of and the rigor of a million lines of code? So that's the thing. So I mean, as I said, a good fund manager will really add value on the risk management side and make sure that your funds are better protected, and that ultimately will end up with higher returns.
Thank you, ma'am. Ma'am, there's a question from Mr. Ronit. He says that, do you think sovereign bonds around the world are in trouble worldwide this time? We see historic moves in yen, and are we in a monetary crisis?
I don't think we are in a monetary crisis or anywhere close to that just now. I mean, we are, in terms of US anyway, you're printing your obligations are in your own currency, so it's not going to be a default or anything like that. And I think to a large extent the interest rate hiking cycle is also behind us. So I don't see, I am not in any kind of doomsday kind of scenario anywhere.
Thank you, ma'am. Back to my colleague Harveer for some further questions, if there are any.
I think there are a few. I'll just quickly see which ones are those. I think Salman Khan was asking, ऐसे participate.
Okay,
So
for one of the earlier questions, I just like to, since you asked about advice to the youth, one major thing which I forgot is you must look at global diversification, because there can be no long-term planning without that. And I will tell you this, that when I started working, the dollar was 12 rupees. Now it's 83, 84 rupees. So it's an 85% depreciation in the course of less than a career. So when you are talking long-term financial goals, you cannot ignore global exposure. So because India is ultimately 3-4% of the world, and there's no reason why 90% or 100% of your assets should be in that one geography. And for all those who say that, but India is the fastest growing economy, and therefore why should I look elsewhere? Again, look at history. In the 90s, which were the fastest growing economies of the world, they were called the Asian tigers. So they were all these Southeast Asian economies. And 25 years ago, there came what is called the Asian crisis of around 1998. In 1 year, those markets were down between 50% for Taiwan to 90% for Indonesia and Thailand, South Korea, Philippines, all of them in between. So anyone who was living in Indonesia and had invested only in Indonesia would have been down 90% in 1 year.
Yes.
And that was one of the reasons, one of the triggers for us to go global, that you should not be exposed to only a single economy. So for young people in particular who have a long time horizon over a period of time, the rupee slides, and that erodes the value of whatever you are saving and investing, amongst other things, amongst the other fact being that don't put all your eggs in one basket. So, I mean, those were the highest growth economies in the world, I repeat, and still you had a crisis. And even without a crisis, as I said, we have a 85% depreciation in less than a career. So those are the things. Sorry, Harbir, back to you. You were asking a question.
So just that this is something that came. I'm asking, carrying on with what you were discussing, ma'am, with this LRS TCS being increased, how is it impacting the global investment? Because global diversification is something that I learned from you, and I've been very vociferously promoting that even when I'm talking to investors and my distribution partners now. But with earlier in those days it was 5%, so it was a much easier task to do, and you could invest up to $2.5 lakh abroad. Now with just with it increased to about 20%, for someone who wants to invest $1 lakh, $100,000, has to pay a TCS of $20,000. Obviously he can reclaim it as a refund,
Right.
but then that does discourage the investor quite a lot to look at global investing, not only in equities but in any form of global investing. So how does one look at that?
Yeah, I mean, there's nothing that can be done about it. The good thing, of course, is that you can claim it back. So that's it's actually only a cash flow issue for a few months. But I mean, it is what it is. As I said, for a long-term horizon, this should not matter, because, as I said, it's only a cash flow thing for a few months. It is something that you will get a set off for. So it's not really. I mean, it's just that when money goes out of your pocket, you feel it, because that's the way. Again, this is also a human bias that you feel that.
Correct.
But if you look at it rationally, it is just a few months when that cash was anyway going to be given, and it's given a few months earlier. That's all it is.
So the question is from Mr. Raghav Tandon. He's got two questions, one of which you've already asked on the positional trading part. I believe you very well covered that. On trading is actually not a productive activity for youngsters until unless someone is very hands-on with it. The other question that he's asking is, credit card debt is on the rise in India. How much will this impact the economy?
So it is not just credit card debt. Overall, if I see all retail debt, especially non-housing debt, is rising, and that is a cause for concern for me. Because part of it, of course, is going to even, let's say you buy a luxury car, you're getting it funded, but some part of it also is coming out of basically people feeling the pinch on the income side and using debt to fund consumption. And I've also heard of, now, of course, yesterday the RBI tightened norms on retail lending, and that the new regulations came out. I have still to go into the details. But as I said, I am a nervous investor in banks and lenders. In fact, non-bank lenders, we hardly have had any position ever. And banks also, I would have loved to ignore if it wasn't the number one weight in the index. So even so, I mean, 2020 and 2021, we hardly had any exposure to bank. We had, but far less than the index. And then both those years, like Nifty Bank was the only sector index in the negative in 2020. In 2021, it was up, but only half as much as the market. I think market was up 22. This was up 11. Last year, middle, we went market weight on banks because we saw the cycle changing in terms of fundamentals, credit growth growing, NPA behind them, etc., etc. But now again, we've started to, I mean, last couple of rebalances, we've cut again. as I said, कि people tell me कि आपका तो तकिया कलाम है कि I'm a nervous investor in banks. The problem with lenders is that as an outside investor, you can never know what's going on inside and where the problems lie. It will just come as a negative surprise one day out of the blue. And we've talked about HDFC Bank earlier. So let me tell you this, that while Amazon was a pure numbers call, that yes, I mean that this is what was happening on the cash flow. HDFC Bank, yes, there was this whole business case to be built for private banks and all that. But there was also a comfort factor for me. As I said, it was a plus call, because a lot of people in HDFC Bank, including Aditya himself, were all ex-colleagues from Citibank, including their risk team. In fact, the risk head was my last boss in Citi, and I said that if he's looking after risk, I know his risk will be managed well. So I have, so that was part of the call, that HDFC Bank se negative surprises ka come chance hai, and which also did happen. They steered clear of that whole infrastructure funding boom and things like that. But otherwise, in a bank, you don't know what's going on, where they have lent, kahan se kuch gadbad ho jayega, and it's a leverage sector. So आपका capital कम है, और आपने इतना lending किया हुआ है, उसमें अगर 5-7% bad हो गया, तो suddenly you will have a negative situation. So that's why I'm just generally careful on banks and lenders. So I will not take a lot of risk there, because that's part of our whole risk averse thing, that there are enough places where you can make money without taking undue risk.
Right. So I think we'll take this as a last question, and this probably I'll answer. How to predict about loss-making newly listed fintech companies by Ranjit Asati. I would simply say avoid them altogether at all costs. Don't even look at them, is the best way to predict how to be there.
Scared of, because again, with a long memory, you remember every few years some boom comes in lenders of various forms. Kabhi wo leasing companies aati hai, abhi ye fintech aayi hai, and it's all internationally also. BNPL, what does BNPL mean? Buy now, pay later. It is the same thing as the 100 saal pehle bhi installment scheme hoti thi. It is the same thing, just rebranded. As someone said, the all innovations in finance ultimately come down to methods of increasing leverage. वो खाली अच्छा नया fancy नाम आता है, अभी fintech है. And lenders, I always laugh when people say that they are growing ahead of projections. I say that how hard is it to hand out money? Return होगा ना, तब बात है. People say that I am lending more than I planned to. How hard is that?
How hard is that? Correct. Makes sense. So as you rightly said, पैसा देना सबसे आसान है. आज P2P प्लेटफॉर्म्स भरे पड़े हैं. एवरी अदर डे समवन कम्स एंड सेज कि सर ये P2P प्लेटफॉर्म में BNPL में फंडिंग कर रहे हैं, एंड दे आर पिकिंग अप मनी लेफ्ट राइट center at 11-12, in fact in certain cases as high as 16-17% as deposits, covering them as small deposits of 50,000-60,000 rupees or a lakh rupees. But we always believe what ma'am is, I would simply endorse what ma'am has said. Be careful with your money. You have to be very careful with the Lakshmi. दिवाली का टाइम है, लक्ष्मी सबको चाहिए, सबने पूजा भी की होगी, पर उसका ध्यान रखना सबसे ज्यादा जरूरी है. So with that, ma'am, thank you so much to you and your team, Achin, Harsh, everyone, for sparing time for this session. It was a very exciting and insightful session for all of us. Good catching up with all of you all over again after almost 11 months, and look forward to more such sessions. Thank you so much, ma'am.
Thank you, ma'am.
Chetan, and thanks to all the viewers.
Thank you.
Bye, and have a great new year.
Yes, ma'am. And we look forward to a great 2024 and a decade also, ma'am.
Right, ma'am. Thank you, viewers. Wish you all a very happy Diwali and, of course, festive season ahead. Keep investing. The risk of not investing is the biggest risk of all, is the biggest takeaway from this entire session. Raghavji, it was my pleasure. This is why the session was to take your questions and get them answered from Devina ma'am directly. And she's been kind enough to do that. Achin, thank you for a lovely run through with the processes and the philosophy of, for First Global and its fund performances. Look forward to more sessions and thank you, everyone. With this, we end this session.
It was a pleasure to be here. Thanks a lot. Bye.
Thank you, Arbir, and the PMStimes team. And Varun.
Bye-bye. Thanks, everyone. Thanks, team.